If you have $50,000 sitting in a checking account right now, you are, statistically, doing something almost no billionaire on earth does with their money. Not because they're smarter than you about saving. Because a bank account is, for someone with real wealth, one of the worst possible places to keep it. It gets taxed on the way in. It earns almost nothing sitting there. And worst of all, it's already been through the one event the wealthy spend entire careers of lawyers and accountants trying to avoid: being counted as income. So where does the money actually go instead? Not under a mattress. Not into gold bars in a vault, despite what the internet tells you. It goes into a system that has a name most people have never heard, even though it's legal, well-documented, and sitting in plain sight in Senate investigation reports. It's called buy, borrow, die. And once you understand how it works, you'll never look at a billionaire's modest salary the same way again. Let's start with the single fact this entire system is built around, because it sounds almost too simple to be a loophole. In most tax systems, including the United States, you are not taxed on wealth. You're taxed on realized income, money you actually receive, usually by selling something or getting paid a salary. If the value of your house, your stock portfolio, or your company goes up by $10 million this year, and you don't sell anything, the tax authority cannot touch that $10 million. Not 1 cent of it is taxable. It just sits there on paper as what's called an unrealized gain. This single distinction, realized versus unrealized, is the foundation of almost everything you're about to hear. So here's step 1 of the strategy: buy. Wealthy individuals overwhelmingly hold their net worth not in cash, but in appreciating assets, company stock, real estate, private businesses, art, and other holdings that grow in value over time without ever being sold. A tax law professor at USC named Edward McCaffrey gave this whole strategy its name, and the buy part is the easiest to understand. You simply don't cash out. You let the asset appreciate year after year, completely untaxed, for as long as you're willing to hold it. Now here's the part that should genuinely surprise you, because it's the opposite of what most people assume. A team of economists, Leskow and Fox, published research in 2025 through the Yale Budget Lab specifically studying how the ultra-wealthy actually behave, and they found that borrowing, of any kind, makes up only about 1% of the total economic income of the top 0.1% of Americans by net worth. That's a strikingly small number for a strategy that gets so much attention. Their conclusion was blunt. The dominant strategy isn't aggressive borrowing at all. It's simply never selling, and letting gains pile up untaxed until death. Researchers have started calling that quieter, less flashy version buy, save, die. The borrowing piece, the part everyone talks about, is real, growing fast, and important for specific situations. But for most of the ultra-wealthy, the bigger story is almost boring. They just don't sell, and the tax bill never comes due. But when the wealthy do want to spend money, $100 million for a new property, a business acquisition, or just funding a lifestyle, that's where step 2 comes in: borrow. Instead of selling stock and triggering a capital gains tax bill, wealthy individuals take out loans using their appreciated assets as collateral. The most common version is called a securities-backed line of credit, or SBLOC. Essentially a loan from a bank using your stock portfolio as the security, the same basic idea as a home equity loan, but backed by shares instead of a house. And this is where the actual numbers get eye-opening. Morgan Stanley has reported that its wealth management clients now hold north of $68 billion in non-mortgage, securities-based loans, a figure that has roughly doubled since 2016. Bank of America's wealth management division saw its own securities-based lending jump by about 50% between 2019 and 2022. This isn't a fringe tactic. It's one of the fastest-growing product lines inside the private banking arms of the biggest financial institutions in the world. Why does borrowing beat selling? Because loan proceeds are not income. When you borrow $100 million against your stock, that money isn't taxed because legally you haven't earned anything. You've just taken on debt, the same as anyone who takes out a mortgage. You still owe the loan back eventually, and you still pay interest on it. But that interest rate, often in the low single digits for a wealthy client with a large, diversified portfolio as collateral, is frequently far lower than the capital gains tax rate they'd otherwise owe if they simply sold the stock outright. And there's a name in the public record attached to exactly this behavior. Elon Musk has publicly and repeatedly used his Tesla and SpaceX shares as collateral for personal loans, rather than selling shares outright, a strategy that's been reported on for years precisely because it's such a clean real-world example of how this mechanism works at the largest possible scale. Now let's get to the part of the strategy that actually eliminates the tax bill completely, instead of just delaying it, because this is the piece that turns a clever workaround into a genuinely multi-generational wealth machine. Die. When someone holding a large stock portfolio with enormous unrealized gains passes away, their heirs don't inherit the original purchase price of those assets for tax purposes. Under a rule called the stepped-up basis, the asset's cost basis resets to its value on the date of death. In plain terms, if you bought a stock decades ago for $1 a share and it's worth $1,000 a share when you die, your heir's tax basis becomes $1,000, not $1. If they turn around and sell it immediately at that same $1,000 price, they owe capital gains tax on a gain of exactly zero. Decades of appreciation, entirely erased from the tax ledger, in a single instant. And this is where the loan actually gets settled too. The outstanding debt from all that borrowing typically gets paid off out of the estate, often by selling a small portion of those newly stepped-up assets, which can now be sold with little to no capital gains bill of their own. The loan disappears, the taxes on decades of growth disappear, and the family's net worth passes on essentially intact. And this rule isn't some obscure loophole quietly sitting on the books waiting to be closed. It was recently expanded, not restricted. The tax legislation passed in 2025, sometimes referred to as the One Big Beautiful Bill Act, explicitly preserved the stepped-up basis rule at death, while also permanently raising the federal estate tax exemption to $15 million per individual. That means a married couple can now pass on up to $30 million in assets with no federal estate tax at all, on top of the stepped-up basis benefit erasing the capital gains. Congress has floated the idea of eliminating step-up in the past, most notably in 2021, but every attempt has failed to become law, and the most recent legislative action moved firmly in the opposite direction. Now let's talk about where all of this actually sits, physically and legally, because borrow against your stock is really just one tool in a much bigger toolbox the ultra-wealthy use to hold assets outside anything resembling a normal bank account. One of the more surprising vehicles here is something called private placement life insurance, or PPLI. On paper, it's a life insurance policy. In practice, according to an 18-month Senate Finance Committee investigation completed in 2024, PPLI functions as a wrapper that lets ultra-wealthy investors hold hedge funds and private equity inside an insurance contract, where the investment growth compounds completely tax-deferred, and the eventual death benefit passes to heirs income tax-free. The Senate investigation found the domestic PPLI industry holds at least $40 billion across roughly 3,000 policies, an average of well over $13 million per policy, and represents just 0.003% of all individual life insurance policies in the entire United States. In other words, this isn't the life insurance your parents have. It's a completely different financial product that happens to share a name with one, built almost exclusively for people with 8 or 9 figures to shelter. Senator Ron Wyden introduced legislation in April 2026 specifically targeting these policies, calling the industry a tax shelter masquerading as insurance. And the fact that it took an 18-month federal investigation just to produce a basic public estimate of how big this market even is tells you something about how little visibility exists into where wealthy money actually sits. Layer on top of all this the more familiar tools, trusts that hold assets outside an individual's personal estate entirely, holding companies that own operating businesses and real estate on a family's behalf and family offices, the private wealth management firms that exist solely to manage a single family's fortune across all of these vehicles simultaneously. None of these are exotic secrets. They're standard tools taught in estate planning courses. What's remarkable isn't that any single piece of this is hidden. It's that almost nobody outside the wealth management industry understands how the pieces click together into one continuous system. Hold the asset, borrow against it instead of selling it, and let it pass to the next generation with the tax bill erased. Let's put a real number on what all of this actually costs the rest of the system, because that's ultimately the finance story here. The Yale Budget Lab's modeling estimates that under current law, the effective tax rate on borrowing against an appreciated asset runs about 12 percentage points lower than the tax rate on simply selling that same asset. That gap is the entire engine. It's not a bug in the code, it's the direct, working result of a tax system built around realized income, applied to a world where the wealthiest people almost never need to realize anything at all. Multiply a 12-point rate gap across tens of billions of dollars in securities-based loans, tens of billions more sitting in PPLI policies, and untold trillions in simply unsold, appreciating stock, and you start to see why using a savings account for someone with this level of wealth would almost be an act of financial self-sabotage. Here's the part one actually want to hear your take on, because there are genuinely two very different ways to see this. Some people look at buy, borrow, die and see the tax code working exactly as intended. Nobody is taxed on wealth they haven't realized. That principle applies to everyone equally regardless of net worth. And if a middle-class homeowner can also take out a home equity loan against their house instead of selling it, the mechanism itself isn't actually reserved for billionaires. It's just that billionaires have vastly more appreciating collateral to work with. Other people look at the exact same mechanism and see a structural unfairness. A system where a salaried worker gets taxed the moment their paycheck lands, while someone with a stock portfolio can spend just as freely without ever triggering a taxable event, and where a 2025 law just made the exit ramp at death even wider instead of narrower. So which is it to you? Is this simply the predictable result of taxing income instead of wealth, something available in principle to anyone with an appreciating asset? Or is a system where borrowing functionally replaces earning, for people who can access it at this scale, something that needs to be rebalanced? Drop your take in the comments. This is one of those debates where the same set of facts genuinely leads reasonable people to opposite conclusions. Let's close with where the actual bill for all of this lands, because, same as every system we've broken down on this channel, somebody always ends up paying for the gap. The federal government collects less in capital gains and estate tax revenue than it would under a system that taxed unrealized gains directly. A shortfall that shows up in the debates over funding everything from infrastructure to healthcare. Banks and private wealth managers earn steady fee and interest income running the machinery, the splocks, the PPLI wrappers, the trust structures that makes the whole strategy work, which is exactly why securities-based lending has been one of the fastest-growing product lines at firms like Morgan Stanley and Bank of America. And ordinary taxpayers, who overwhelmingly earn their income through a paycheck rather than an appreciating asset portfolio, end up funding a proportionally larger share of the tax base simply because their income is realized automatically every single pay period with no equivalent borrow instead of earn option available to them. There's no single villain running this system, and no secret vault where the money physically sits. Just a tax code built around a 100-year-old definition of income, a financial industry that has gotten extraordinarily good at helping clients live comfortably on the gap between borrowing and earning, and a stepped-up basis rule at death that, as of 2025, isn't going anywhere. The next time you hear that a billionaire only reported a few $100,000 in taxable income for the year, you'll know exactly where the rest of it actually went, and exactly why it never touched a bank account on the way there.